Good morning, good afternoon, good evening, folks. It is Thursday morning, and you know what that means. That means we bring back the one and only Jonathan Twomley. How you doing, sir?
As I said before, I am super tired because I woke up in the middle of the night worrying about this deal I'm working on, and couldn't get back to sleep. So I'm going on fumes, and it's only 10:30 in the morning.
Oh, I know you got this. You'll be just fine. But yeah, when you work on deals, you know they sometimes can wake you up. So
Yeah, that's the downside of real estate deals. You're dealing with millions of dollars, and in the middle of the night something occurs to you, and you're like, did
ah,
I cross that T or not? And
yeah,
then you're like, okay, I can't fall back to sleep until I hear back from my lawyers, who are of
yeah,
course asleep.
yeah, exactly.
So
Well, hey, one of the things I wanted to do today is you put out a post that I actually read through twice now on your Facebook group. So let's give the name so others can follow it. But basically saying that you, Jonathan Twomley, are more afraid of deflation than inflation. Now you use the word crash instead of deflation, but really, as we sit here today and we look at it in the future, we're trying to make money decisions. Jonathan, you are more afraid of deflation than inflation. Let's talk about why.
okay, well, the first reason is just sort of like what happens during deflation as opposed to what happens
Mm-hmm.
during inflation, right?
Mm-hmm.
And yes, inflation uh, means that your money becomes less worth less over time, right? That's the value of your money is eroded,
Mm-hmm.
but the money itself doesn't disappear, right? So you start out with $100, you still have $100, but your $100 is going to be worth 97 or 95 or
Yeah, something
whatever it
less.
was in real terms, right?
Mm-hmm.
Deflation, however, means that, well, if you have cash, that's great. Well, actually, on the inflation side, I'm sorry. On the inflation side, if you own assets, that means your assets are going to go up in value, right? So
Correct.
that's good. The opposite is true for deflation. And deflation, when that happens, well, if you've got cash, that's great because your cash,
Mm-hmm.
you have $100 today, and in real terms, it's worth $102 tomorrow or next year or whenever it is. But if you have assets, oh boy, like
Ooh,
your
yeah.
money will disappear. Like, so your asset that was worth $100, maybe worth $75, and it doesn't take a year for it to happen. It
Mm-mm.
happens pretty much overnight. And then the issue really becomes like, can you hold out long enough
For it to come
for
back. Yeah.
for it to come back or not? Or are you going to be forced by your debt service, or you're going to be forced by uh, you know, having to refinance
Yeah.
to either give up the asset or put in more capital or whatever. So and debt is what makes deflation scary and what makes inflation uh, interesting
Yeah.
as an
Of
investor,
course.
because debt means that it during a crash, what kills you is not the loss of value, right? It's the loss of value relative to the amount of debt that you have on the property and whether you can service the debt or not.
Correct.
And so the debt can make your portion of it go to zero. Now, if you have, say, 75% loan to value on your property and you lose 25%, you're at zero, right? The
Mm-hmm.
property may be worth 75% of what it was. Your
Mm-hmm.
stake in it is now zilch
Mm-hmm.
because you bear the first dollar of loss as the equity holder, right?
Correct.
So debt is the thing that always kills people in a crash, and that's what killed people in 2007,
Correct.
was that they had in many cases over leveraged their properties. And now the
Mm-hmm.
reason I'm afraid of a crash is because we are seeing, as you and I have talked about quite a lot, uh, we are seeing a lot of over leveraging of properties in a new way, right? The banks don't let you put more than 75% equity on, sorry, debt on property. They don't let you put subsequent, uh, additional layers of debt on property. So people are doing it in a kind of roundabout way, either by putting preferred equity
Mm-hmm.
in their loans to effectively get the leverage higher, or they are using a lot of interest only to, they can't get more proceeds, but it's like having, you know, more debt on the property because you don't, it's basically like having more leverage
Mm-hmm.
because you're getting more better return on your equity as a result of
Mm-hmm.
not having to pay interest for a while. So this is how a lot of deals are getting done at the moment, and it's adding risk to these deals. So I think that when you have the amount of asset inflation we've had over the last year, especially, you just run the risk of like running away, prices running away, and then people pulling back because they can't afford them anymore. They can't justify the prices, and that's when the music stops. And so that's what I'm now. That's one reason I'm more, I'm sort of afraid of deflation. But in terms of why I'm not as afraid of inflation, well, there's a couple of reasons. One is that, inflation is running hotter than it for a while, for the last few months, than it has been for some time. That's absolutely true, right? This is running at 5 to 6%, which we haven't seen in about 30 years or so. However, if you kind of look at what happened before this, after 2007, when every central government in the world just threw money at everything, people were screaming, "Oh, we're going to have inflation." The gold bugs went nuts. The price of gold went up, and then what happened? No inflation. They couldn't even hit their 2% targets that central banks had for inflation. And that the reason for that was because of all these huge deflationary pressures on the economy in the form of outsourcing,
technology,
etc. Right. So now we definitely have inflation, but it's mostly because people are buying stuff like crazy. They're also getting paid more. And we've got these bottlenecks in the economy that have, that as things have come out of COVID, like they just couldn't respond fast enough, right? So that's just basically basic supply and demand stuff, right? You also, there's beginning to be some evidence now that there's a lot of price gouging going on, or companies using this 5% inflation to jack prices up like 25-30%, right? So I actually saw this going clothes shopping. I don't know if you know this. I lost a lot of weight recently. I decided to take care of myself, so I had to go buy a whole bunch of clothes. And I went to a place where jeans are always priced basically always $39.95, right? Okay. Went there, $49.95, right? Now that's a 20% increase in the price when we have 5% inflation, right? So that's just one data point. But I mean, I was actually reading about this the other day, that there seems like there are a lot of places that are like, hey, we can raise prices because everyone thinks this will. So they're raising prices by a lot more than inflation, but that's just going to make inflation higher, right?
Of course,
they're raising prices.
Spiral,
more. Yeah. So that my view continues to be that this is temporary, and when the bottlenecks are worked out, we'll kind of go back to where we were. And but the other thing too that we have to be concerned about is just demographically, right? Demographically, we're kind of the population growth in the United States is slowing down, and that is going to have a big impact on the economy. And that's kind of, we talked about the similarities with Japan and China, but I mean, we also have a demographic, I wouldn't say time bomb like China has, but we have a demographic, certainly, like, I don't know, downward slope that we're heading into. And I think that also adds to more deflationary pressures as well. So I'm not that concerned about inflation, but I do think that, like, 2 years ago, I thought we were overpriced in the property market. Now, now 2019 looks like a bargain. And that is, I think that's a big issue.
Yeah, I think there's a couple of things that I want to tie this together, because again, I do this show one rental at a time, and I'm always telling people what I'm doing in my business. So first and foremost, I think it was you and I talked like 6 months ago, it might have even been 9 months ago, that I personally was seeing behavior in the multifamily space, at least in the debt structure, that was very similar to residential in 06, 07. It was just a bad debt structure that was destined to blow up. Now, just like residential, it took time, right? It took about 2 years, right? Because there was very common 2 and 28, right? 2 years at 1.9, and then after 2 years, it went to 7.9 or whatever it is. That was destined to blow up because you couldn't refi forever. Now I was starting to see, like a year ago or 9 months ago, kind of the same similar behavior, right? You're getting 70% loan from a bank, then you're layering on this piece and IO here and this and that. And I'm like, that eventually is not going to survive. And that's why I've been telling limited partners or LPs, some of you have done deals and your money's gone. You don't even know it. And the other thing I'm doing in my business is I spent about the last year taking all of my multifamily debt, 5 and above, right, commercial, and getting it on 30-year terms. And some of them I went non-QM and paid a higher rate because I'm afraid of where, this party goes, because I don't want to have to refi in an environment where the value is down, because I can hold. I want to be able to hold throughout it, right? Some of the stuff I bought, like a house I bought for 200, went all the way down to 100. It didn't matter. It cash flowed. I could hold it, right? If I had to refi when it was 120, I didn't want to write that 40K check or lose it, right? So I'm seeing the same kind of things. And I think the last year or so has been that final, to me, it's a party, right? To me, it's a New Year's Eve party. Everybody was super excited. The alcohol was flowing. The music was great. Midnight came. And what happens is, a lot of people leave, but there's always that 20% that stay too long. We are in that stage right now. It's like, you guys have no idea. You can't, you're stumbling around. You don't even know what's going on. You're just doing it to do it. It's bad.
Well, there's certainly, I mean, I'll say this, that if you have the multifamily property now, right, people I'm talking to are getting incredible rent bumps.
Oh yeah.
In certain markets. I mean, unbelievable. Like, they're just turning apartments without doing renovations and getting $300-400 rent increases, right? And so that is helping a lot of people, but that's also justifying paying. That's forced, cap rates have compressed even further now, where, we're now, a couple of years ago, or even last year, when people were talking about multifamily assets trading at a 5 cap, they were like, that's crazy, right? 5 cap for a C property. Now I'm seeing, 5 cap being described as a bargain, right? Because things are trading at 3 caps. And if you're buying stuff at a 3 cap, believe you me, like, you want to be locking in that long-term debt right now, and you want to get those rent increases as fast as you can to, like, stabilize your property at a better cap rate that gives you a little more room, for when the inevitable happens.
It'll happen.
In terms of the economy or inflation or what have you, like, whatever is going to happen, there's going to come a time where, everyone says, oh, there's a housing shortage, there's more demand than there is supply, as if, well, that is unwavering, that can't change. The demand can change if there's and we see this happen all this time, where if the economy, if something, we saw it happen last year, right? Where if for some reason people can't afford to pay rent, they will move in with someone else and not pay rent, or pay less rent, or move in with their parents, or go back to wherever they're from. It doesn't, just because there are a lot of people, doesn't mean that they are going to rent, right? So the supply side of the transaction may be more difficult to change, but the demand side can change, and
instantly.
It can move very fast, right? So just because there is a quote unquote housing shortage, as the realtors define it, as being like the population is X and the number of houses is Y, and therefore there's a deficit. Well, that only takes you so far. That's great when the economy is roaring back, but it's not so great when, there's a recession, which is triggered by who knows what. It could be inflation, and the Fed raising interest rates, right, to starve inflation. I mean, we don't know what's going to cause the next one. We haven't had a real, we had this COVID thing, but we haven't had like a real business cycle recession in a very long time now. And
it's coming.
It's coming. So
and the last thing I'll say on this topic is, in my opinion, we've proven how we can beat inflation, right? Paul Volcker showed us how to do it. I don't know that we know how to beat deflation, at least significant deflation. That's a scary concept, frankly.
Well, I mean, actually we did, though. I mean, if you think about, we did.
Okay.
I mean, that was what Bernanke, Bernanke, who was a student of the Great Depression and a follower of, Milton Friedman and other people who, basically said that the problem with the Depression was the lack of liquidity.
Correct.
Right. So when the Great Recession happened, Bernanke and the other heads of central banks around the world got together and they said, we have to get ahead of the lack of liquidity by pumping a ton of money into the system. And that's the same thing that they did last year too,
Okay.
right? Which was, because that was the fear. And I mean, remember we talked about this, we talked about or at least I know I remember writing about this, where that the Fed, as soon as COVID hit, everyone dropped interest rates to zero. And the reason was because they were very afraid that all of our over leveraged corporations,
Yeah.
if they had any slowdown in business,
Yeah.
and they
Cash
had
flow
to,
hiccup. Yep.
yeah, and they had to service their debt at high,
Mhm.
which is variable at high interest rates, they were going to all go bankrupt,
Yep.
right? So they slashed rates to nothing to basically stave off a wave of corporate bankruptcies.
Okay.
And so we do know how to. I mean, we've seen examples of Japan where they just haven't been able to do it, but they're also hit that. I think it's the deflation plus the population decline.
Oh,
that
the
is
combination.
really
Yeah.
hard to defeat. But I mean, you can pump the
Okay.
system full of money and increase liquidity. However, I mean, at some point you pay the price, right? So yeah.
Well, very cool, Jonathan. We got 2 more exciting topics. How can people follow you?
So you can join my Facebook group and see these posts for yourself. It's called the Multifamily Investment Community. So just come on by on Facebook, drop in there, say hello. And if you would like to invest with me, we actually have a deal going on right now that you can invest in if you are an accredited investor. So please Google Two Bridges Asset Management and fill out the investor form, and I'll be in touch.
Very cool. Thanks, Jonathan.